Hello, everyone. Welcome to Spy Trader, your go-to financial news podcast. I'm your host, Jimmy Cheddar, and it's 6 p.m. on July 29th, 2024. You know what they say about time. It's money, so let's get right to it. In today's episode, we're covering the latest key news items shaking up the S&P 500, providing you with in-depth analysis and, of course, some solid trading recommendations to keep your portfolio in the green. And hey, stick around for a joke that'll tickle your funny bone. Trust me, it's worth the wait. Summary of key news items. First up, interest rates. The Federal Reserve has increased interest rates by 5.25 percentage points from March 2022 to July 2023, setting the federal funds rate to a range of 5.25% to 5.50%. Investors are now betting on rate cuts by September and at least two more by December. Second, major tech stocks have experienced a sell-off, which UBS calls a buy-the-dip opportunity. Despite the dip, tech valuations remain attractive with strong fundamentals, indicating promising growth in AI investments. Finally, the market is awaiting key economic indicators and earnings reports from tech giants like Microsoft, Apple, Amazon, and Meta this week. Early mixed earnings reports have added a layer of volatility to the markets. Analysis and insights. All right, let's dive deeper. With expectations for rate cuts growing due to slowing inflation and economic growth, the sentiment among investors is cautiously optimistic. Lower interest rates typically benefit sectors like utilities and real estate, but the overall impact on the S&P 500 could very well hinge on how these anticipated cuts play out. On the tech front, the recent sell-off looks temporary. UBS sees this as a buying opportunity, especially given that tech valuations are lower relative to the dot-com bubble era. The earnings coming out this week are crucial. Microsoft, for example, is expected to report an EPS of $2.94 on revenue of $64.5 billion, driven significantly by its cloud and AI segments. Meanwhile, the Fed's possible move to cut rates could lower the cost of capital for businesses, which is undoubtedly positive. However, let's not forget inflation. While rate cuts can stimulate growth, they can also lead to inflationary pressures. Lastly, the cautious approach by investors, reflected in the mixed performance of the S&P 500, suggests a need to balance between growth and defensive stocks. Trading recommendations. 1. Buy tech stocks on dips. The sell-off in tech offers a golden opportunity, particularly in stocks like Microsoft and Amazon. Their fundamentals remain strong, and AI-related growth is expected to drive future revenue. Microsoft's deep investment in AI and cloud services makes it a solid pick. 2. Focus on utilities and real estate. If the interest rates are cut, these sectors will likely benefit. Utilities and real estate stocks can provide stability and attractive dividends as borrowing costs decrease. 3. Monitor small-cap stocks. The rotation into smaller companies suggests potential in the Russell 2000 index. While inherently riskier, these could offer substantial returns if economic conditions improve. 4. Diversify with bond funds. Given the significant inflows into bond funds, a balanced portfolio should not overlook fixed income securities. These can provide a cushion against equity volatility, especially in an uncertain economic environment. And now, as promised, here's a little humor to wrap things up. What do you call a depressed stock? A blue chip on its shoulder. That's it for this episode of Spy Trader. Thank you for tuning in, and remember, stay informed, stay savvy, and keep trading smart. Catch you next time.